Hi, this is Dave Elhoff, the Financial Thought Doctor. This video today is to give you an outline on dimensions of life insurance. It's a tutorial designed to teach you to think a layer deeper on how you may be able to use a properly structured life insurance policy that can maximize benefits for you during your lifetime. Life insurance company is a financial institution providing you with two sets of financial benefits. Number one, financial products that protect against financial losses due to death, disability, long-term care, critical illness, and in some cases, claims of creditors. It has products designed for building wealth with guaranteed cash value, tax advantages that can provide education funding, lifetime retirement income, non-recourse loans, and much more. One of the life insurance company's financial products that includes virtually all of these benefits is called Whole Life. How whole life insurance works: millions of people and corporations around the world own whole life insurance, with trillions of dollars paid into it as the foundation. It is popular because it helps protect your economic life value and typically provides the following benefits: immediate legacy for heirs or charities, guaranteed premium payments, guaranteed cash value, tax advantages, creditor protection, which varies by state, and opportunity for retirement income. First of all, your premiums. Your premium is guaranteed and can never be increased by the insurance company. Premiums are paid for a specified period of time based upon the policy type. You may also be able to change or reduce your premium in the future based on options within the policy design. With your premium, you have a guaranteed death benefit. Your premium provides immediate protection you seek and set the stage for future benefits. This is made possible by combining the premiums of all the policy owners of the company, where you are one person in a pool of many. You have guaranteed cash value. After the first few premiums, an ever-increasing proportion of your annual premium is credited as your guaranteed cash value. The guaranteed cash value is contractual and cannot be reduced by the insurance company as long as required premiums are paid. You can choose to let these cash values accumulate, withdraw them, or use them as collateral for a loan at any time. Any loans taken are eventually repaid out of death benefits or from cash values. If the policy is surrendered, interest on policy loans will accrue if not paid, increasing the loan balance. The policy owners can decide when payments are made and in what amount. Care should be taken and payments of interest made to avoid having a policy lapse that could create a taxable gain. Recaptured premiums. In future years, the guaranteed annual cash value credited to your policy may exceed the guaranteed premium paid in that year. Also, over the life of the policy, the total guaranteed cash value may exceed all premiums paid. This illustrates that some or all of your premiums for lifetime death benefit coverage are recaptured within your cash value. Dividends and interest. This is the only portion that is not guaranteed. There are two types of life insurance companies offering whole life: mutual and stock companies. Mutual companies are owned by their policyholders and operated for the benefit of their policyholders. Typically, surplus from their well-managed operations are paid in whole life policy owners in the form of dividends. Investors own stock companies and generally are the primary recipients of any dividends paid, Owners that whole life policies issued by stock companies usually do not receive dividends unless their insurer is owned by a mutual holding company. Interest may be paid on dividends held on deposit by either mutual or stock companies. Dividends and interest are not guaranteed, but many dividend paying whole life policies companies have paid dividends every year for the last 100 years or longer. You have options for the dividends. The dividends may be paid in cash, reduced premium, purchase paid up additions, accumulated interest, purchase 1 year term in life insurance, pay loan interest or loan balance. Paid in cash. If it's paid in cash, that's a tax-free dividend that's paid to you, and you can use that cash for whatever purpose you want. You could use it to pay your auto premiums. You could use it to pay your auto lease. You could use it for trips. Whatever you want to do, if it's paid in cash, it's yours to do with it as you please. It can be used to reduce the premium on your life insurance policy. It can use to purchase paid up additions, which will cause an increase in your cash value and an increase in your death benefits. You can have them accumulate at interest, where they're at the insurance company owning their declared interest rate. You can use it to purchase one-term life insurance, 1 year term life insurance. And you can use it to pay loan interest or loan balance. So let's take a look at this. For this particular individual, I'm showing someone that's age 39, and we're going to show and illustrate through age 89. First off, we got the premium. The premium on this particular policy, this policy has a premium of $17,795. It's got guaranteed cash values. It's got a guaranteed death benefit. With that $17,795, we got a guaranteed death benefit of $1,500,000. If nothing else happens, what is here is going to happen on a guaranteed basis, meaning that you would have over $1 million in cash value and $1,500,000 in guaranteed death benefit. However, with this particular company, we have dividends which are not guaranteed, and as those dividends start to build, it's going to be used in this particular situation to increase the cash value. As you can see, if we were to look at age 55, cash value on a guaranteed basis, $271,000. The cash value on a non-guaranteed basis, because we have dividends coming out, is $292,000. And because we're using these to buy paid up additions, we get an increasing death benefit over time. It's the way this policy would work. Now, this cash value, either the guaranteed or the non-guaranteed, is available for whatever you want it to be available for. It can be used to collateral loans with the insurance company. It can be used for college education. You could use the dividends to assist with college education. So it's very flexible product that you have. Okay, the guarantees are this. You got guaranteed annual premium, guaranteed cash value, guaranteed death benefit. Once paid, the value of dividends and interest cannot be reduced. So your guaranteed premium, the contractual change in cash value every year looks like this. You can see as you go through here, your policy is growing by more than what you are putting into the contract, thereby recapturing your premiums. And you got a guaranteed annual cost or gain throughout the life of the contract, looking something like this. And that creates your guaranteed death benefit. That's all contractual. Nothing else happens. This is guaranteed to have happen what you want to have happen. So, an overview. Whole policy dividends are not guaranteed. They provide you with the ability to grow cash value, increase life insurance coverage, and or reduce out-of-pocket costs. You can be paid in cash, reduce annual premiums, purchase paid-up additions, accumulated interest, purchase one-year term life insurance to increase protection, or it can be used to repay your policy loan. Paid in cash, the annual amount comes out, you use that money as you see fit. Reduce annual premiums, you can see that you can use the premiums, the dividends there to reduce the premium. Or eventually you would not be out of pocket anything for the premium because the policy is paying it through the dividends that are being generated. Can be used to have additional paid up insurance, causing your net costs to go down every year. In fact, it starts over a period of time. And you can make it so that you can use, there's no net cost in the contract at all, but yet it will continue to call. So it's a very flexible plan. Now, the most important thing that I teach people to think a layer deeper about, it's more important your savings rate than your return on investment of how you're going to do in retirement. And one of the things that I try to teach people is that you must know how to get a dollar to do more work than a dollar's worth of work. With this insurance policy, we have what I call a money multiplier. And let me explain how that would work. Whole life simultaneously provides economic value protection as well as asset protection, and it acts in a multiplier effect. Whole life enables other assets and financial strategies to perform better, especially in retirement. Whole life simultaneously performs functions for the accumulation, distribution, and conservation phases. These unique aspects of whole life make it one of the most valuable financial tools to own. The value of a properly coordinated whole life policy is that it can provide a death benefit to your beneficiaries while simultaneously increasing your wealth and income during your lifetime. First, the premiums go in and it creates a death benefit for us. And that's guaranteed and that's all contractual. Next, we have an increasing death benefit if we structure it properly so that we're keeping pace with inflation. We have a disability waiver premium. What that means is that with the properly structured life insurance, if you become disabled or you're too sick or too injured to earn money, the company is going to make that premium payment for you. There's no other asset out there that has that design where if you're too sick or too injured to work, that will make a contribution to a fund for you. So we know that's going to take place, and we take one of those risks, the risk of disability, which over 30% of the people are going to be disabled at some times during their life. Protection from creditors. This depends upon what state you're in. Is that if you're in a properly structured life insurance policy, those cash values and death benefits can be exempt from creditors. We have accelerated death benefits. What that means is that we can use the policy if we have a situation where, for instance, critical illness long-term care, that we can use the death benefit on a tax-free basis to cover those costs. So you see what's happening here. We're starting to light up more of our drawers on our model here. Thereby, just having those dollars go into this life insurance policy, we're already getting 1, 2, 3, 4 uses out of that money. Estate distribution options. Here's another one, is that because it's a life insurance contract and there's a beneficiary designation, it bypasses probate. It goes directly to the beneficiary of your choice without taxation. So it's got estate options. So we also have estate conservation options here. Because of the presence of life insurance, it allows us to be more generous with our charitable giving opportunities, where we can give an asset and be able to replace that asset. That's where the asset protection feature starts to come into place. Government plan maximization. This gives us the opportunity, because of the presence of life insurance in your model, where we're going to be able to have uh, pension plan maximization or government plan maximization, where we can wait to take Social Security so we get a maximum benefit. We can evaluate how to get the most out of Social Security because of the presence of the whole life. We have cash value. Now we're starting to light up this portion of the model. We have cash value that's accessible to you at any time without penalties for college education, second homes, other investments, and retirement. We've got dividend options. So, dividends as they are coming out of our policy, we have that available to put into an investment or save or spend. We can borrow from the policy. And the nice thing about this is that even though we borrow from this life insurance contract, we don't affect the growth within the policy, so that when we go to pay back the loan, we have not lost our position on the compound interest curve. If you borrow anywhere else, you have to, in essence, drain the tank that you have saved over a lifetime and start over again on the compound interest curve. Over a lifetime, that can be huge in terms of lost opportunity costs for you. Now, the living value of whole life insurance is coordinating benefits to identify how the whole life policy may be used to enhance existing assets or permit certain strategies to increase retirement income, reduce taxes, provide for a future legacy, and ideally do so with no additional out of pocket outlay. Let's take a look and see how this may work. Cost reduction. With the dividends, we can use those dividends to reduce our lifestyle costs for necessary things like auto insurance or property insurance. Charitable giving. We can afford to give away appreciated assets knowing that we're going to be able to replace that asset to our heirs tax free. Asset pay down. Because of the presence of life insurance, we're more inclined to more aggressively enjoy the wealth that we've accumulated over our lifetime by structuring pay down strategies whereby we're going to reduce taxation during retirement instead of increase taxation during retirement, because we have the presence of the whole life. This gives us the opportunity that instead of living off interest, which in today's world of low interest rates is very difficult to do, to take and annuitize assets and have a guaranteed lifetime income because of the presence of the whole life insurance. Pension maximization, being able to spend down our pension assets more aggressively because knowing that if something happens to us, that pension is going to be replenished by the life insurance. Retirement plan recapture strategies. There's many strategies by combining charitable giving and whole life insurance, the presence thereof, that we can maybe take something that's 100% taxable and convert it to something that is 100% tax free. You win, your heirs win, and charity wins. Income maximization, same thing, allowing us to maximize our income in more aggressive strategies because we have a safe asset that is protecting these assets as we go to collect income from them. Volatility defense. With the stock market, when it can get very volatile, it gives us permission to allow these assets to recover because we have another source of tax-free income that's available to us to supplement it during times when we may not want to liquidate appreciated assets or assets that have undergone a temporary adjustment in their value. So, in addition to volatility defensive income, as income could be fluctuating from different assets, we also have the volatility defense of the principal that may fluctuate up and down. Enhancing collectibles and property enhancements. Many people collect these things that are very valuable. They could be gun collections, art collections, jewelry, so on and so forth. They don't produce income, but we have ways to structure strategies where they may be able to be converted into income. Reverse mortgage. Because of the presence of the whole life, we're going to be able to have a reverse mortgage over our lifetime, reducing our out-of-pocket costs for living expenses, yet knowing full well if something happens to us, that mortgage can be paid off if desired. Business continuation enhancement. Many of the business, J.C. Penney, Walt Disney, saved their businesses because they had the presence of a whole life policy. Many times it borrowed from those contracts in order to continue to grow their business. So the living value of the death benefit is huge. If you think a layer deeper, owning a whole life policy with other assets demonstrates that it is more than just death protection. Owning whole life in retirement can enhance the performance of other assets, creating additional retirement income. Whole life can protect your other assets from eroding factors such as market risk, inflation, income taxes, illiquidity, and more. So that's what I have for you in this particular presentation. I have one thing that I want to share with you, and that's this. We have a plan, and our plan always looks like it's straight growth to the finish line. But when we get to reality, it looks more like this. We have peaks, we have valleys, we have issues that go on. That's what happens when life happens. Having a whole life policy looks more like a plan that is very stable, has some guaranteed contractual values in it that you can count on. The rest of our life is fraught with risk and things happening that may take away from our overall plans. By having This participating whole life insurance in your model will make everything else stronger. Thank you.